You ready?
Yeah, go ahead.
Okay. Hi there, everybody. My name is Donald Zuckerman. I am Colorado's Film Commissioner, and I am with the Governor's Office of Economic Development. And we are today presenting this webinar about the federal government's Paycheck Protection Program. Behind the curtain is our webinar wizard, Kelly Bogg, and she will be curating your questions. So there is a Q&A box. So please type your questions into that, and she will be looking for, redundancies and everything, and make sure that every question that's relevant will get answered. So we have a distinguished panel today. First of all, I'd like to introduce our moderator, Doug Price. Doug is currently CEO and chair of Citizen State Bank, and some of you in the film and television industry may remember him as the longtime CEO of Rocky Mountain PBS. We also have Marie Peters, who is with Colorado Lending Source and at one time was at the Office of Economic Development. And we have Alexander Price, who was also with Citizen State Bank as the Chief Strategy Officer. Doug is moderating, so Doug, please take it away. Thank you.
Well, I do want to, and Alexander, has Jessica joined us or is she tied up?
Nope, she's on.
All right, great. We also have with us Jessica Frigetto. Jessica is our Chief Lending Officer for the organization and knows all those detailed underwriting questions as we move forward. So the purpose today is really to help funnel you to places where you can get your questions answered. And we will send out this deck that we're going to go through today with your questions, and it'll have our contact information. But I want to start out by doing what I think is the most important thing, and that is getting us our email addresses to you so that you can ask questions. And so I'll start with Alexander. Alexander, can you read off your email address at CSB, Citizen State Bank, and let them know what to do?
You bet. So I'm just at aprice@csbcolorado.com.
And Jessica?
So mine's J Frigetto, so JFRIGETTO @csbcolorado.com.
And we're working on a theme here. Mine is dprice@csbcolorado.com. And then Marie, can you give yours?
Sure, it's marie@coloradolendingsource.org.
So welcome to all of you who are on the phone call today. We have a pretty good list right now. There's over 30 people that are in attendance. And the reason you're here is likely that you're curious about PPP. And we're going to go over 3 different components of it. We'll go over, probably the most important thing today is what is known as PPP2 or Draw 2. Most people have had a success getting PPP1 or Draw 1, but some of you will have questions about that. And then we'll touch on the Save Our Venue feature of the enabling legislation so that everybody who might have a venue understands without great detail that piece of the puzzle. So what we wanted to do today is have Marie start out by giving kind of an overview of some of the things that they're involved with, and then we'll move to Alexander for a much more detailed conversation and slideshow of the elements of PPP.
Great, thank you so much, Doug. My name is Marie Peters, and I work with Colorado Lending Source. We are a mission-based nonprofit organization, and our mission is to foster the economic growth of diverse small businesses within our communities. And so we do that by participating in a lot of the U.S. Small Business Administration loan programs, including SBA 504, which helps people purchase commercial real estate. We help lenders across the state access the 7A program, which is a guaranteed loan program, and we have direct lending as well. In 2020, we were very active as a PPP lender for the first draw, and also helped lenders submit PPP loans as well. And in the second draw, we have partnered with Lendio, so folks that don't already have a lender that would like to apply can go to our website, coloradolendingsource.org, should they need to apply. And we're also happy to answer any questions or concerns.
Alexander, let's have you go ahead and walk through with the screen share what we're looking at, and we're going to moderate the questions. I would note this to Kelly Bogg. I'm having trouble getting that Google Doc open, so we'll see what occurs there. But
Okay.
off we go. Let me also, by the way, give my cell number. Partially it's for Kelly, but the rest of you can call me. My cell is 303-378-2141, and you're welcome to call me with any questions. Thanks.
All right, Kelly, if you can pull up the deck that you have.
Yes.
All right, so let me start at a high level, just kind of breaking down what we'll talk about today. So we'll talk a little bit about what's new in this existing round. We'll also talk about how the previous round will, how PPP round 1, what's called first draw, how folks who have not yet accessed that can access it. And then importantly for this group, which is heavily film, stage, et cetera, we'll touch on just briefly the Save Our Stages program. And we're not experts. We work with folks who are and can connect you with people to help get a little bit more context. But essentially, for anybody who is in the film stage business, who runs a business through that, particularly if they have venues, it's going to be an either or. You can't do both. So Kelly, if you can start on the slides, the next slide.
Yes, sorry, Alexander. There we go. Got it.
Okay, so real quick, if this is your first PPP loan, this new legislation that opened and started accepting applications starting Monday of this week for a small subset of banks, Friday, today, for all banks under $1 billion, which Citizens State Bank is one, and then on Tuesday of next week for the broader public, your very large banks, Wells Fargo, et cetera.
We would interject that Citizens State Bank has staff available all through the weekend. So not me, but Alexander and Jessica are working all weekend. And so we will be able to accept and process applications starting immediately if you so need. So keep that in mind in terms of the timeliness moving forward.
Yeah. So what this does, if this is your first PPP loan or what's called first draw, this opens that window of availability until March 31st, 2021. The SBA does not anticipate running out of funds, but it's always better to be first in the line to go as quickly as possible. And we've encouraged all of our previous borrowers, of which there are almost 300, to apply as quickly as possible. There are some changes in the covered period with regards to the purposes of the loan qualification. There's some waivers of affiliation rules and the extension of the loan period. The first draw loan does not require, and you may have heard this in the news, does not require a 25% reduction. The first draw loan is really just if your business, if you can certify that your business is in challenging times. And I think right now most people would agree that it's quite challenging times. It's the second draw that requires you to certify and demonstrate a 25% quarter over quarter loss, 2019 compared to 2020, and it can be any quarter. Kelly, if you can go to the next slide. So what's new in this particular time? So this covers some additional stuff. So previously it primarily covered payroll, rent, and utilities. This now covers some operations expenditures. It also covers any property damage that was incurred. It covers some supplier costs, and it also covers PPE or worker protection equipment. Kelly, if you can go to the next slide, please. It also allows you some flexibility in terms of your selection of your covered period. In the last PPP round, it required that you either chose an 8-week period to be covered or a 24-week period to be covered, which also included that you had to maintain the employment levels at those rates. And most people ended up somewhere in the middle, 10, 12, 14 weeks before they'd successfully and correctly spent all the money. This now allows you to choose anything between 8 and 24 weeks. And so it gives you additional flexibility. Just a reminder that you may have heard, about 60% or exactly 60% of your expenses need to be payroll. If you, for example, applied in the first round and did not successfully spend 60% on payroll in the previous PPP round, you would actually be ineligible for this program because they would have deemed that you had spent the funds incorrectly, even if you might have been 55% payroll. So just something to keep in mind. Kelly, if you can go to the next slide, please. There's also changes in terms of the calculation of loan amount for farmers and ranchers. So previously it had been based on net profit. It's now based on the gross income that you generate in a particular year, largely because oftentimes farms in particular have a challenge turning a profit. And so this was the decision of the Congress to basically make this easier for folks to apply. It also simplifies the forgiveness process for loans of $150,000 or less with a one-page form. And that's going forward as well. So we've seen actually the ability to submit for forgiveness be much, much simpler. You know, for a time, you had to fill out 12 pages, then you had to fill out 2, and now you just have to fill out this one form, assuming that you're $150,000 or less, which really makes up the vast majority of loans that are out there for PPP.
And a quick comment about forgiveness is that it seems very confusing to people, but we have been an industry leader in getting PPP forgiveness. At this point, a little more than 3/4 or nearly 80% of all of our loan borrowers from the first round have applied for forgiveness. And 100% of those who have applied that have been forgiven were fine. It was smooth. We didn't have anybody that we rejected. And about 25% of our remaining applications for forgiveness are pending approval, but we have not had any real challenges from the SBA getting the borrowers approved for forgiveness, mainly because we have a very strong education program that the moment you get your loan, we go through weekly mailings and many webinars to help you stay on top of what you need to do. But there was a question pre-submitted about the forgiveness process, asking if it could take as long as 5 weeks, and the answer is yes, it can take as long as 5 weeks. It can actually take as long as 90 days, almost 3 months, once you submit the application to get approval, but that has not been our experience so far. I'll turn it back to you, Alexander.
Okay. Yeah, and just to give a little bit more color on what Doug said, you know, we've seen that we've been able to apply for forgiveness. So banks, it can actually take even longer than 90 days because banks will they have up to 60 days, excuse me, to apply for that forgiveness on your behalf, and then the SBA has 90 days in which to respond. Generally, our average processing time on the bank side is about a week, and it is varied in terms of the forgiveness side. We've seen anything from a week, I would say probably an average is somewhere between 2 and 3 weeks. We've definitely seen some long ones. There's a handful that are close to the 90 days, but those tend to be the loans that are over $1 million or in the $2 million range. Kelly, if you can go to the next slide, please. So what's new this time? This also eliminates, you might have heard about the EIDL or EIDL, the Economic Injury Disaster Loan Advance Reduction from the forgiveness amount. So a lot of people received an EIDL advance. It was anywhere from $1,000 to $10,000 in the last round. It was a program that was administered by the SBA. And they essentially said that if you received a $20,000 PPP loan and a $1,000 EIDL advance, your forgiveness was reduced by that $1,000 EIDL advance. They've now reversed that. And so folks who did previously have a PPP one and had the $1,000 or whatever the amount was removed from the forgiveness amount, you'll be actually seeing that money again. It's going into your bank, and your bank will then remit it back to you. It also includes a do-over provision for loans that were returned in part or full. So for example, if you took a loan and then realized you were not going to be able to spend it or only spent a portion of it, you can then actually reapply. And you can either reapply, if you returned all the loan, you can reapply for the entire loan in its entirety, or you can reapply for the portion that you did not consume. Kelly, if you can go to the next slide. This also expands eligibility. So to 501c6 organizations, excluding entities that have a large lobbying wing. I believe it's over 20% of their business is done by lobbying, and those with more than 300 employees. So the first round was 500 employees. This round is 300 employees. It also does include housing cooperatives, newspapers, broadcasters, and radio stations, both public and private radio stations. And those were some that kind of got left behind in the last round. And we actually did quite a bit of advocacy with Congress and with our representatives to try and get those included, because they're businesses like any other that really support our economy. And so that's the main goal. Kelly, if you can go to the next slide. So your eligibility for the second PPP loan, you have to have fewer than 300 or fewer employees. And you must have used or will use all of your first PPP loan prior to the disbursement of this second one. You don't have to have received forgiveness, so that's okay. They have told us that if you have applied for forgiveness and it is in the portal and in review, it may delay it. And so you'll want to work with your lender to make sure that they're applying the appropriate pressure with the SBA to get that issue resolved. You must also demonstrate that you have a 25% decline of revenue in any quarter in 2020 as compared to the same quarter in 2019. And this is where I think a lot of people will have questions. So if you were down in Q1 of 2020, that would qualify compared to Q1 of 2019. Same thing for Q2, Q3, Q4. If you're a relatively new business, if you started in 2019, you would want to compare your Q4 of 2019 to any one of the quarters in 2020, Q1, Q2, Q3, or Q4. If you were in business and you started, let's say you started just at the very beginning of 2020, let's say you started January 2020, you can compare your Q1 to Q2, Q3, or Q4 to demonstrate that 25% decline. There is a maximum loan amount of $2 million. There is also what the calculation is your monthly payroll multiplied by 2.5. However, if you have businesses that are in hospitality, and this means that they have an NAICS code or NAICS code or an industry code that starts with the number 72, you can actually multiply the loan amount by 3.5. And Patrick Muller just asked a question. The 25% is gross revenue, correct? And what they call receipts. So, let's say it's possible, it depends on how your accounting works, but it's possible that your receipts might have gone down, but your revenue technically remained the same. For film venues, I would guess that they're more or less the same number. Kelly, if you can go to the next page.
And as we go, there's several questions at pre-advance that I did get that Google Doc open, and they ask how much assistance can a business request. And the point we make is that although other expenses now qualify more liberally, it's really about payroll. So it is 2.5 times the selected payroll, or 3.5 times if you're in the hospitality industry. And the code that Alexander is referring to is on your tax return. I can't remember which page, but those codes that start with 7.2 indicates you're in a hospitality business. And generally, you're going to talk about caterers, restaurants, hotels, motels, RV parks, places that take visitors and host them for food or for lodging. But you generally will know if you're a hospitality business. And the other issue is the other point that people ask about, and Jessica, when the time comes, we'll ask you to talk about the expenses, is that in the past, we counseled our people, hey, if you're going to use it on payroll, it's safe, right? You're going to get forgiven because of the emphasis on payroll. But now there are other expenses that qualify. And a lot of the questions will be about that, but be patient. We'll make sure we cover qualifying expenses when we get Jessica up. She's seen 84 of these things now, so she'll know a little bit more about what to look for.
Yeah, and an important note, so it's your, generally it can be your payroll from 2019 or 2020. You take the entire year's payroll. Any individual who earned over $100,000 is capped at $100,000 for the payroll that quote unquote counts. So if you had somebody who was, let's say you had 2 employees, one of them made $50,000 and one of them made $150,000, the total annual payroll that you can submit for is actually only $150,000, the 50 plus the 100,000 cap for the second employee. And so, you know, those are important components. You are also allowed to add in things like employer contributions, excuse me, to retirement, employer contributions to insurance, for example. You're also allowed to add back in state and local tax. That number tends to be smaller, but the health insurance, depending on how you operate, can tend to be fairly sizable. So, and
it's odd, you know, I stress it's odd because you can add back in state and local taxes, but you can't add back in Social Security taxes, for example. So the federal taxes are not included. The state and local taxes are included.
Yeah. Now, you know, one of the big things that you'll see, and we've worked with a number of film groups in the first round of funding and got them their first PPP round. And in the second round, they came to us and they said, what is better, PPP2 or the Save Our Stages or SOS funding? We're not experts in SOS, but I thought I would touch on it because if you have the basic outlines, you'll be able to decide for yourselves what works better. Like I said, you cannot select either the PPP program, either first draw or second draw, and Save Our Stages. But just to give you a little bit of color and context on the Save Our Stages funding, the loan amount, if you've been in operation since January 1 of 2019, is 45% of your 2019 gross revenue, which is incredibly sizable. And candidly, you know, when we've counseled our borrowers who are considering the two, almost always the math works out in the Save Our Stages funding favor. Now, there are a couple of things to keep in mind. One is the Save Our Stages funding is certainly guaranteed funds. It's just uncertain how many people will be requiring it, et cetera. Whereas the PPP program is fully flushed out. But generally, I would say the Save Our Stages funding is maybe a couple weeks or maybe even a couple months away from being able to distribute money from everything that we understand. But you will be able to generate more from a loan perspective, and right, these are forgivable loans. So essentially, it's I hesitate to say the word free money, but it's basically free money. If you were not in operation all of 2019, as in 1/1 of 2019, it's 6 times your monthly gross earned income. And there is also a $10 million cap. So in the calculation, it is the lesser of all of these three, right? Depending on when you were in operation. So that's just something to keep in mind. Like I said, the partners that we've worked with, we did PPP1. Most of the time, Save Our Stages is going to make the most sense. There's going to be a little bit more uncertainty since it's an absolutely brand new program, and PPP is a little bit more established, but it's all relative in this COVID world.
And I think one of the things to think about on Save Our Stages is that is not a bank generated program. Is that correct? This is an SBA direct program. So
Correct.
Let me ask a quick question of Marie. Marie, do you know enough to know if you guys will originate, or will this be like some of the EIDL, which is directly and only generated by SBA?
Yeah, my understanding is that it's going to be only distributed and processed by SBA. I did check their website yesterday, and they do have information about the program, but they're not yet accepting applications, as Alexander alluded to earlier.
Yeah, and so and there's actually I saw a great question from Cindy Kessinger. Would a community orchestra be able to apply for these loans where we have 9 contract workers, no full-time employees? If we qualify for the 60% need to be payroll of our expenses. So one of the challenges around PPP is that contract workers or 1099s, they are not included as your employees. Now, if you have contract workers, you can encourage them to use PPP funding on their own. They can apply as individuals, essentially kind of like sole proprietors of their own business, but you cannot claim them. You can only claim either partners in your business, right, that might receive a draw, or W-2 employees. And so that's something to keep in mind, right? I think that sometimes in various industries, contract workers can be a sizable portion of sort of the workforce. You're not allowed to claim your contract workers. That's a great question, Cindy.
I was going to see what other questions you have. Alexander, do you have other slides, or should we open it up for general questions? We can take
there's one more slide.
Great, let's do that.
Yeah. So you can apply for either a second draw PPP loan or an SOS loan, but not both. You can apply for an SOS loan if you didn't receive a first draw PPP loan, but you cannot apply for both a first draw PPP loan and an SOS loan during this next round. So basically, if you're trying to decide between the two, you're going to have to choose one or the other. That's one of the challenging things, is that had you applied for a PPP1 loan before last year, you would be allowed now to apply for an SOS loan and sort of switch programs. But in this case, you can't apply for both. You can only choose one of them. And you do have to certify that you have not, when at least going through the PPP process, you do have to certify that you are not applying for a Save Our Stages funding. And with all the associated penalties. I believe, Kelly, I think that is our last slide. Yep. And so, we can open it up for questions. I did see actually one of my old friends, John Huggins, sent in a question.
And he means that is in terms of age, John, not in terms of duration of friendship.
No. It's just a friend from a long time ago.
Let's grind through some of these questions, and we'll sort of move that. With respect to Linda Brown's question, small nonprofit with a reserve, Jessica, do you want to tackle that one? If you have a small reserve, what are there any prohibitions against getting a PPP loan?
Can you read? I can't see the question. Does it just say if you have a small reserve?
We're a very seasonal, small nonprofit. Will we be punished for maintaining an operating reserve that is necessary to our survival each year? Our operating reserve is around 40,000 with an operating budget of 400,000 in normal times, reduced to 250,000 during the pandemic. So the question is, does the reserve?
Would not. You would
I
not
think
be
that's what,
punished for having that reserve.
yeah. We think you're wise for doing it, and you're not punished. And we've had that with a number of different nonprofits that we've dealt with that have, even some that have endowments but have been negatively captured. I think with respect to the EIDL loan, we have explained that the EIDL now is sort of neutralized, if you will, and you can qualify for the second round moving forward. I think Alexander answered Elliot's question, about how that goes. It does get a little binary in the second round. If you haven't applied for the first, you're limited to either selecting one or the other. If you were in the first round with PPP, we have this situation. If you were in the first round with PPP and now you want to save our venue grant, you can do that. The SOS funding, that's a good question, and I don't know that I know the answer. Alexander, in your work, do you know if the SOS funding has to be accompanied by a 25% decrease in a quarter as well?
You know what? I have some vague recollection that it is. Unfortunately, that's not a program I'm a perfect expert in, but I have some vague recollection. But what we'll do is we'll follow up this webinar with that with everybody who's signed up with an answer to that question, because I think we should be able to track that down fairly easily.
And then the payroll amount, Jessica, have you seen this issue already? The selection between 2020 payroll and 2019 payroll. So is the payroll amount for round two based on our current payroll or what it was in 2019? Can you give a sense of that?
Yeah, the guidance allows you to choose either one. So it allows you to use the calendar year 2019 or the 12 preceding months before your loan request or your funding date, which is essentially calendar year 2020. You're allowed to make that choice. For some borrowers, 2019 is going to result in a much larger loan amount. So depending upon the amount of funds that you think you can use within your either 8 or 24-week covered period on payroll, some customers were advising to use the 2019 payroll data. As far as your employee count, it's going to be your current employee count, no matter what year payroll you choose.
And there is a maintenance of effort required in the employee body, right? Meaning at leave, there's an expectation they'll look at your continuing employment to qualify for forgiveness.
Correct. And then 60% of those funds, at a minimum, 60% of those funds need to be used on payroll. The other 40%, as in draw one, could be used for items such as mortgage interest, rent, utilities. They have also added 4 other caveats, so covered operation expenditures. So that would includes items like payment for any software, cloud computing, human resources or accounting needs, covered property damage costs. So if you had property damage due to any public disturbances that occurred during 2020 that are not covered by insurance, any covered supplier costs, or any covered worker protection equipment, so PPE.
Let me give a specific question that was in my Google Doc that came in before. Somebody who runs an electrical company asked, could they count their accountant? And I think that's the quick answer is you couldn't account your accountant if they were an outside accountant as part of your payroll. So just to make sure that question is clear. But would the payment to a professional like your accounting service be considered an allowable expense under the new act in the 60-40 split?
It would. You're exactly right. You could use that payment as part of your 40%. So when you're making those payments, just make sure that you're documenting that. So through forgiveness process, for example, we ask for payroll documentation, but then we're also going to expect documentation for how the other 40%. So bank statements, copied of canceled checks, statement showing, or a credit card statement showing where it's been paid. Those are different items, including invoices. Those are important items that you should keep handy.
Did we get John Huggins' question answered? My company received 107,000 round one, and we are eligible for about 157. Does the 150,000 simplified forgiveness limit apply separately to each round, or is it cumulative?
It's separate for each round.
So the first one, John, would be eligible for forgiveness with the simplified form. The second one would require the easy form. So that is logical. Let me see. The 25% reduction is gross revenue. Many people have different nets, so that's important. We talked about the payroll, the employee resignations. The quick answer is if your payroll is down, Jessica, in round two, can you go to an earlier period for payroll, or do you have to use your current smaller payroll as a calculator? So let me read the question. We had a couple of employees resign this year, and we are still in the rehiring process. Will this reduce our second draw PPP amount, or is there a way to represent these unfilled positions that the new loan will help us pay for?
Yes, so you could still use your 2019 payroll data, calendar year 2019, to establish your amount of your loan request or your average monthly payroll, and then multiply it by the 2.5 to come up with your loan amount. You're going to use current employees, and then, for example, if you choose a 24-week option, and then you're able to fill those positions, your number of employees on your forgiveness application would actually be higher.
Again, let's cover. I think we've got all of those. If there's any, the chat I've got, I'm going to go back to the questions. What costs are applicable under the new forgivable expense allowance? And then they say all job supplies and questions. All job supplies and parts? Question mark. So can you talk a little bit more about what you perceive to be qualified expenses, Jessica?
Yes. So going back to the 40%, I believe, is where the issues come up, or people aren't exactly sure what's qualified. Would you interpret it the same way? Payroll cost is pretty defined.
Yeah.
Okay. So the guidance that I have seen, for example, for covered property damage costs, says costs related to property damage due to public disturbances that occurred in 2020 that are not incurred. Covered supplier costs includes items such as, it says, expenditures to supplier pursuant to a contract purchase order or order for goods in effect prior to taking out the loan that were essential to the recipient's operations at the time which the expenditure was made. Supplier costs of perishable goods can be made before or during the life of the loan. PPE, I think, is fairly explanatory. I'm just thinking about, even here at the bank, I'm thinking about masks, gloves, I'm thinking about plexiglass shields, I'm thinking about even decals to put on the floor to keep people separated 6 feet apart. I'm thinking about all of those types of things, signs to tell people that they need to wear a mask, or various functions of that would all, in my opinion, be considered. The other big one to me this time is payment for any software, cloud computing, and other human resources or accounting needs, because so many of these are outsourced and were not captured before. These are people that you'd maybe be sending a 1099 to before. They're not an employee, but they're definitely large expenses that your business has. When it gets into rent and mortgage interest, you also can use, if you have equipment leased or equipment loans, you can use that interest as well, or leases for equipment.
Great. Meg Stites, you had a question on the number of employees. Do I have to count full-time only, or should I also include part-time employees? And it says Kelly would like to answer this question live. Kelly, does that mean you would like us to answer it live, or you would like to answer it live?
I certainly do not want to answer it live. Please go for it. It's just a button. I've got to click on it. Thanks.
Yeah. I think that's a great question. And the quick answer is you're able to count part-timers and aggregate them into FTE equivalents. So your part-time employees can count and do count, but usually you're calculating it. Jess, talk a little bit about the experience in the first round, which we expect to follow through.
Right. Initially, if you received a PPP loan in the very beginning phases, it was just defined as employee. So a lot of people had to go back and then revise their applications to be FTE. That was allowed. The guidance still stands. The application still references employee, but if you find the definition of employee, it is full-time equivalent. So you do need to think about those part-timers and the hours they work. For example, if you have 2 people who are working 20 hours a week each, then they would be 1 FTE.
The other a good question before we go to David Dadone's, I don't know how to pronounce that name. David Dadone sounds right though. Angela Craven's question is really good, and we dealt with this a lot. Talk again about our sole proprietors and how that worked in the past. So Angela's question, to read it, is, can you please speak to how first round PPP works for sole proprietors this year? And I think that's both first round and second round. I think they're the same. But talk about how the sole proprietor is treated in this process.
So if they have a Schedule C, which would be, for example, John Doe doing business as Doe Concrete, they're going to be using their net income from their Schedule C and then taking that, dividing it by 12 to come up with their average monthly payroll, times 2.5 to come up with their loan amount. And you'd be looking at your 2019 tax return.
Right. I see a former client, Bill, at the Butterfly Pavilion. In round 1, forgiveness was simplified if you could demonstrate a reduction in income due to reduced capacity caused by CDC guidance. And the reality is, even in round 1, you really didn't have to even show that. You just had to maintain employment and express that. So the question becomes, will those same rules apply? For example, we had about a 75% decrease in FTEs from 2019 to 2020 due to CDC guidelines. We anticipate the covered period to be more like 2020 than 2019. I have to think about that a little bit. This is one, so Jessica, can you see that on your screen, the question? It's a little complicated. So you've got a reduction in force because the CDC reduced who you could have. How do you read that question?
Alexander, do you want to dive into the safe harbor?
Yeah, so the safe harbor bill would essentially protect you. So because based on CDC guidelines, you're legally required to reduce capacity. If you do have to reduce FTE, safe harbor and it's the certification in PPP round 1 essentially said it shielded you from requiring to go through layoffs or reduced hours because of a state, local, or nationally mandated health guideline. And so in your case, you should be protected from a decrease in FTEs.
Bill, I do think that if I would you, and you're looking at a second round, I might see with appropriate counsel, would this be a save our venue opportunity if you wanted to go to round 2? Because obviously you're going to face that. Now you guys are really good fundraisers as well. So I don't have a real appreciation for the 25% reduction in overall revenue, but certainly the visitor days are way down for you. So I would examine that. The other issue, which is a really good question from John, the new allowable expense categories like HR, software, accounting, cloud computing, et cetera, only apply to second round. Do they only apply to the second round, or do they apply to forgiveness of first draw PPP loans as well? So are the new rules retroactive to the first round of PPP?
My assumption for forgiveness is that they're applicable to only round 2, but to be honest, we have the majority of our portfolio already forgiven or at least submitted. So I have not had to investigate that much with the SBA.
Yeah, John, we can take a look at that to see if it applies only to second draw loans. My understanding is the same as Jessica's, that it's only second draw loans that have these new expenses. There was some tuning that was done in this recent legislation to correct problems in the first draw, but I believe that the new allowable expense categories are at least designed only to be for second draw. Now, and one of the things to keep in mind, and this is true for Save Our Stages as well as PPP, is Advocacy Matters. And so as you come across issues that you feel like either don't make sense or what have you, we would strongly encourage you. You can be happy we're happy to be the vehicle, but we'd strongly encourage you to reach out to the delegations. We managed to get co-ops included in the first round and be able to help public radio stations and television in the first round. And that wasn't because they were initially in the legislation. It was because there was advocacy that was done with our, Ed Perlmutter, Scott Tipton, with our representatives, because there's a myriad of different corner cases that the people creating these programs aren't thinking about, and they're not thinking about the ways to support our economy. They're certainly thinking about those things, but they're not seeing the full picture, right? You in your everyday lives and the work that you do, you power small parts of the economy. And the idea for these programs, the gist behind them is to support those efforts. And so when you run into roadblocks, I wouldn't accept those as final. We did a lot of work to make sure to advocate for our customers, because it was the thing that made sense and it was the thing that was right. And so, I would say the interpretation, this program, we were talking to the SBA yesterday, this is the kind of program, and I'm sure Save Our Stages will fall into this category as well once they have more firm rules. It's the kind of program where you can be right on Monday and wrong on Wednesday. And that's a good thing as well, right? They're listening, they're hearing what we need, and they're trying to respond. And they have limited ability to, they have guidelines, but it can matter. And the second round of PPP is a good demonstration of the mistakes that happened in the first round, what it means for the second round. They've corrected things. So democracy is a messy thing, and this is a good example of that being the case. But we would encourage you to reach out to us. We're happy to talk about things and prompt the SBA to give us more clarity. Because if you're running into something, you're surely not the only person, right? People across America are looking at this program and saying, that doesn't make sense, or this little piece doesn't make sense. So.
A couple questions. David Dodona, I think you, by the way, Bill, thank you for closing off that question on the Butterfly Pavilion that was about forgiveness, and the safe harbor did apply. With respect to the venue grant, I think that's what Alexander is really saying, is that not everybody anticipates. You'll have flexible space. They talk about fixed seating. We have had some clients already we've talked to that not only did they not have venues, but they might have rented venues that they used to move forward. So there's an examination of that, and that's a pretty fluid one. That's going to be one where the SBA has the best advice. I want to go back to what Alexander said about advocacy. When we had our situation, we're in Scott Tipton was our representative and Lauren Brobert is now. But when Scott Tipton was here, we had the national leadership of SBA willing to tackle questions with us. The 5-state region head, Scott Tipton, we had this one memorable night. Barbara McLaughlin, who's our Democratic representative, our county commission is almost all Democratic now. But the point I make is that irrespective of party, we had an unbelievable participation from our elected reps to be really granularly involved in the solution of individual problems. When we received when we're able to get the rural electrical cooperatives included, which they did nationwide, the SBA regionally let us know that it was our work with those clients that changed the national policy. So we stress to you that it's very responsive. And, again, our former rep was great. We have reached out to our new rep and have had no answers yet. But it's early to say the least. We won't get into any controversies there. But many of you are in the creative, all of you are likely in the creative industries. And so as you do that, just be aware that it's not everything here was created for the Colorado workforce, even though we were very competitive in the Colorado workforce. The Colorado workforce tends to be, in business formation, tends to be more self-employed, more creative everywhere, not just out of Donald's offices. So keep in mind that your questions we are able to take directly to the SBA and get answers for. And they enjoy doing it. The service that has been levied on behalf of the Colorado workers has been amazing. And as I said, it hasn't depended on parties so far. It's just depended on you. So keep that advocacy going. I think we have a couple of questions about the Save Our Venues stuff, but do talk about, Jess, talk about the flexibility of going between 8 and 24 weeks that's in the new legislation on the covered period of expense documentation.
So generally, we advocate to be able to use 24 weeks, but the flexibility now allows for you, for example, if you've used your funds, or at least a minimum of 60% on payroll by week 13, for example, you can go ahead then and have that be the end date of your covered period. You should check with your CPA or tax preparer in regards to the employee retention credits, though. I do not have enough information. I only have enough on this to be dangerous. You essentially cannot double dip the use of payroll funds. So instead of you selecting a 24-week period, if you've used the funds in a 13-week period, you can still qualify for an employee retention credit for tax purposes. So you'll want to keep that in mind and talk to your accountant before you prepare your forgiveness application to make sure that you're optimizing both your PPP forgiveness, but also that employer retention tax credit.
And
Go
ahead.
Oh, sorry. There were a couple of questions, and I think people have some questions around EIDL, and maybe Marie, you might know a little bit on this, but around, so Len Matteo said, if he received an EIDL loan in 2020, am I eligible for an SOS loan? And then Gwen Burak said, if we received an EIDL loan approved in late December, does that affect our eligibility for PPP2 or shuttered venue? My recollection is no, but Marie, you might know.
Yeah, I agree with you. I don't think that EIDL has any implications on being able to apply for PPP or the SOS. In fact, because of that provision earlier that Alexander talked about, they wanted to make sure that those programs don't overlap. So they're actually trying to unwind them.
Yeah. Barbara Ham asked another question, which I think brings something we talked about earlier to a fine point. It says, the question was part-time, what if they are receiving 1099? And I think that W-2 signifies an employee, 1099 signifies a contractor. And generally, if you're receiving 1099 income, the expectation is that you're on your own in terms of applying for PPP. If you that way, does that contrast with your view of anything on that, Jess?
I agree.
So let me see if we've got everything. Can you confirm that gross revenue includes earned and contributed revenue for nonprofits? The answer so far, Tricia, is yes. The expectation is that it does include all revenue. We have even heard that it included if you had an endowment that went up or down, that had an influence on the way you calculated your income for that quarter. So we're not seeing a rigid interpretation of revenue declines. Interestingly, it's dangerous to say this, but I think our experience with SBAs, they've tried to use common sense to the extent possible in looking at these issues. But a decrease in revenue, we think about it as the top line. I'll give you an example. We've talked to public media a lot, and radio stations and public media that relied on the equivalent of advertising revenue on radio. A lot of them were down 25% because they had an immediate drying up of people willing to spend money to have their name on radio, and they would have recovered. Television stations had these bigger membership groups, and so they didn't necessarily qualify as easily. So you have to look at all sources of revenue, inclusive of grant, to make that decision. Another example of things that happen is that some people would defer their drives, right? So if you have a fundraising drive that you normally would have done in the second quarter, you have a fiscal year end of June 30, and you do a fundraising drive in April, May, and June, and you deferred it to the following quarter because it just didn't look promising, that would count as a decrease in revenue as well. I want to bounce
and
to
if you're looking for a footnote to the guidance, it's section 6033 of the Internal Revenue Code from 1986.
That is a chief
I
credit.
memorized that.
Well done. I think, let me make sure we do a really quick, we're almost coming to the end of our time. I think we've answered virtually all, I think we have some questions about SOS. We want you to talk to SBA about them in terms of the limits there. I'm toggling between chat and otherwise. I think we've answered all the questions we can. Marie just posted, Marie, talk about what you just posted for people to look at.
Yeah, I just posted the link on SBA's website for the grant program we've been talking about. I know we say Save Our Screens. There's also, it's called, I think there might be an alternate name, Shuttered Venue Operators Grant. And so it says more details on eligibility coming soon, but the details that are available right now are on this website. So it includes, what you can use some of the funds for, as well as some other record keeping items. And so I feel like that is the best place to keep on revisiting as they get more information.
So as we get ready to leave, and we'll ask Donald to summarize as we get to the top of the hour, but let me ask each of you to open the chat box, go back to the very top and look at the email addresses. If you send Jessica, Alexander, or me an email, we will add you to our communications work. So we'll treat you as if you're an existing client. We'll add you to our pipeline, and that way you'll get the weekly letters we send. And if you use somebody else, fine, but we have had numerous people ultimately rely on us because of the volume of education that we do. So I have a Chase customer out of Minnesota who I've never met, who heard about what we were doing, and they call me about once a month to talk about their loan at Chase. So we're happy to do that. It doesn't bother us. I'm an old man with nothing but time on my hands. So, but add your name to our list. We'll put you into the pipeline. The pipeline then will have application links. We'll have information links. We'll have everything that you need to start the process moving forward. So we've actually have a collaborative with the Colorado Lending Source. One of their clients in the first round, because they're not directly making loans, is actually using us to make the second round loans for them. So it's a good way to think about where you are and go to the place you're most comfortable in terms of the information you're getting on the new rounds. So with that, Donald, let us turn it back to you to close the session.
Thank you. So first of all, this has been recorded and it lives on our website. And Kelly, can you tell people how to access it? And please refer other people to it, any of your friends that you think might benefit. Kelly?
Yeah, so I'm going to put it in the chat right now, but if you registered for this webinar, which you did because you're here, I'm going to send a follow-up email to everybody with the PowerPoint that Alexander went through, and the last slide of that will have everybody's contact info if you can't write it down really quickly. So I'll put the YouTube link in there for the recording and the slide and any other links that came up today.
Okay, and thank you. And first of all, major thank you to our panelists. They're very generous to give up their time and prepare for this. Thank you so much. And to all the participants, great questions and happy to help. And, you know, just like Doug said, call. Kelly has nothing to do so she'd love to get, no, I'm kidding. She's swamped. But really, if you have any questions, we're officed with the state SBA people, so we can go pretty directly to them and find out, find answers frequently. All right, well, thanks, everybody. Really appreciate it.
Thank you.
Thank
Thank
Take
you.
care.
Cheers. Have a good weekend.
You too.
Perfect.